Winning 5, losing 1, and still going bust. Welcome to the Think Big Trading channel. I used to believe that if I won more trades than I lost, everything would fall into place. My account would grow steadily, and life would get easier. I didn't need to get rich overnight, just a few bucks a day would do. So, I poured my energy into boosting my win rate. I studied every chart pattern, dissected candlesticks, memorized support and resistance zones, and filled notebooks with analysis. At one point, I hit a near 80% win rate. 8 out of 10 trades were winners. Friends were impressed, I felt on top of the world. But then, something strange happened. My account didn't grow. In fact, it shrank. Sometimes, it even plunged into the red. Confused, I blamed the market. I pointed fingers at surprise news, wide spreads, even my broker. But when I sat down, opened my trade log, and reviewed each profit and loss, the truth hit me like a ton of bricks. My winning trades were tiny, 5 to 7 pips, because I'd cut them short, scared the market would reverse. My losing trades? I held on for dear life, refusing to cut losses. By the time a trade was down 15 or 20 pips, it was too late. One loss could wipe out 5 or 6 wins. I was winning often but still losing money. That's when I realized I'd fallen into a trap, a seductive, dangerous trap. High win rates paired with terrible risk management. I know plenty of traders out there are stuck in the same cycle, chasing a shiny win rate, thinking they're on the right track, only to watch their accounts dwindle. One bad trade, and it's game over. Today, I'm breaking down this trap, the psychological illusion of win rates, and, most importantly, how to escape it before it's too late. Because win rates are for bragging. Risk management is what keeps you in the game. The allure of a high win rate. A high win rate sounds irresistible. You place 10 trades, nail 8, and maybe even go on a streak where every setup hits. Your trade log glows green, and you feel unstoppable, like you're joining the ranks of Wall Street pros. An 80% win rate convinces you you're on the right path. You start dreaming, if I maintain this for 3 months, 6 months, how big could my account get? You whip up an Excel sheet, plot an equity curve, and envision a golden future. But you're standing on thin ice. One misstep, and it all collapses. Win rates don't determine profits. They're just a percentage of how many trades you win out of the total. The market doesn't pay you for winning often, it pays based on the size of your wins versus your losses. Here's a simple example, you make 10 trades. 8 win, each netting $10. 2 lose, each costing $50. That's $80 in profits minus $100 in losses, a net loss of $20. Despite an 80% win rate, you're in the hole. Why? You win small but lose big. I fell into this trap myself. I once hit an 85% win rate, stringing together 5 or 6 winners in a day. I thought, I've cracked the code. Just keep this up, and I'm set. Then came a bad trade. A candlestick broke through my analyzed zone faster than I could react. I hadn't set a stop loss, thinking, it'll come back, it always does. It didn't. The price kept tanking. My heart raced, palms sweated, but I couldn't cut the trade. I held on. That one loss erased the profits from 14 prior wins and ate into my initial capital. 3 weeks of grind, gone in one trade. That's when it clicked, win rates mean nothing without risk control. But the real danger isn't the number, it's the mindset it creates. A high win rate makes you cocky. You start thinking you're above the rules. Those nagging voices saying, set a stop loss, manage your risk. You dismiss them as overly cautious. You size up your trades, not because of a solid strategy, but because you believe you're untouchable. I remember a trader named Jake, a buddy of mine in Chicago. Jake was a wizard at reading charts. He could spot trends on the S&P 500 futures before they formed, nail support levels, and call out fake breakouts like a pro. His win rate hovered between 75 to 80% monthly. One day, I asked, "Where do you set your stops?" He laughed. "I don't need them. I read the market too well." 3 weeks later, a surprise Federal Reserve rate hike flipped the market. Jake refused to cut his losing trade, convinced it would reverse like before. It didn't. He lost over 50% of his account, along with his confidence. He quit trading soon after. A high win rate is like a gorgeous cake with a rotten core. You only notice when you take a bite. It distracts you from the one thing that matters, protecting your capital. A good system isn't about winning the most trades, it's about losing small and winning enough. Here's the truth, one big loss can destroy 30 or 40 wins. And it happens more often than you think. If you've never had a single trade wipe out a month's profits, consider yourself lucky, but stay vigilant. It's coming unless you act. Win rates are the shiny wrapper. The real substance of a pro trader is risk management. A tale of overconfidence. Let me tell you about Ethan, a young trader I mentored in New York. He entered the market 2 years ago, quietly soaking up knowledge, backtesting strategies, and grinding on a demo account for 6 months. I respected his patience. Most newbies jump straight to live trading, chasing quick cash. Ethan said, "I'm not ready until I understand my own psychology." I thought he'd stay cautious forever. Then one day, he sent me a screenshot of his live account. He'd turned $200 into $1,600 in 2 weeks, an unreal return. His win rate was nearly 90%, with picture-perfect entries. He was thrilled, sounding like a kid who'd found buried treasure. I replied with one line, "The higher the win rate, the closer you are to a trade that could reset you to zero." He laughed it off, texting, "Don't worry, I've got this." But the market doesn't care about your confidence. The next week, Ethan sold gold futures, betting on a pin bar at a strong H4 resistance. He tripled his usual position size, feeling certain. The price didn't drop as expected, it flatlined, then crept up. At first, Ethan stayed cool, thinking it was testing the zone before reversing, like it had before. But the price kept climbing. Then, a US CPI report came in hotter than expected, and gold spiked. His account bled red. He didn't cut the trade. 2 thoughts consumed him: it'll come back and I can't lose 2 weeks of gains. His account dropped from $1,600 to $800, then $600. He still held on, even depositing another $500 to save the trade. When gold smashed through resistance, his account was done. Late that night, he called me, voice shaking. "It was just one trade, man. One trade, and I lost everything I built." I didn't know what to say. Ethan's story taught me a brutal lesson: accounts don't die from losing trades, they die from stubbornness. That stubbornness doesn't come out of nowhere. It's built, trade by trade, with every win that feeds your ego. Each correct call adds a layer of arrogance. When you win too much, you start believing you're special, that you've got a feel for the market, that stop losses are for suckers. A high win rate isn't something to flaunt unless it's paired with the discipline to lose small. You can win 8, 9, even 10 trades in a row. But one loss you can't control can take it all. The market always has surprises, news, volatility, black swan events. If you let emotions drive you, one trade can cross the line. And when it does, you lose more than money, you lose the confidence you spent months building. Have you ever gone on a winning streak? Did you feel yourself getting bolder, sizing up trades, ignoring rules you once swore by? Have you ever thought, "This setup's a sure thing, I'll be fine without a stop"? If so, pause. Are you trading a system or chasing feelings? Do you have a hard limit for losses, or are you banking on a high win rate to save you? I don't want you to repeat Ethan's mistakes, or mine. A great trader isn't the one with the highest win rate. It's the one who survives the longest. To do that, you need to accept losses early, cut them fast, and protect your capital before dreaming of profits. Only then can you stay in the game long enough to hit the trades that matter and let your system shine over time. The deadly whisper, just one more trade. If you've made it this far, this story's hitting home. Hit that like button to spread the value. If you know someone who needs to hear this, share it to save them from the same wrong turns. Thanks for sticking with me. There's a phrase in trading more dangerous than any red candlestick or blown account, just one more trade. It's quiet, sneaky, slipping into your mind when you're least aware. But if you listen to it, it can erase weeks or months of hard-won gains. I don't recall the first time I heard it in my head. I just remember the day, 3 winning trades, each netting about 2% of my account. My plan was clear, aim for 4% daily profit, then stop. But after the third win, I wasn't satisfied. I scanned the charts and saw a setup that wasn't textbook but looked good enough. I hesitated. Then the voice whispered, one more trade. If it hits, today's a grand slam. I entered. It tanked. Annoyed, I thought, that wasn't my best setup. I'll take one more, a real one, to get it back. Another loss. In one afternoon, I gave back 6% of my account on 2 unplanned trades. The real danger wasn't the losses, it was the regret and urge to recover that followed. That's when the spiral kicked in, more trades, bigger sizes, no stop losses. By the end of the day, I'd lost nearly a quarter of my account. I call this the emotional domino effect. It starts with an innocent, just one more trade. But that trade opens a door to overconfidence, chasing losses, holding losers, and breaking rules. It's not just newbies, even seasoned traders fall into this trap. Take Ryan, a full-time trader in Miami. He lived off trading for 3 years, disciplined as they come. His rule, max 3 trades daily, win or lose. One day, the market was textbook, his 3 trades all won. Over coffee, he told me, I felt like I had the market's pulse today. Then he took a 4th trade. It lost. Regretting it, he took a 5th. Another loss. That day, he placed 12 trades, 3 wins, 9 losses, netting a 1% account drawdown. When you win, you want more. When you lose, you want it back. In both moments, just one more trade, whispers. It's greed dressed up as logic, one more won't hurt. The market's ripe. I can recover. But pros don't trade on feelings, they trade on plans. Ask yourself, how often have you recovered a loss with an unplanned trade? How often has chasing made it worse? Be honest. The scariest part of just one more trade is it robs you of the ability to stop. A small loss feels fixable. A bigger loss feels too far gone to quit. When your account's on the brink, you think, might as well go all in. And then it's gone. My own fall and lesson. Early in my career, I learned this the hard way. I had a $1,000 account, risking $20 per trade, 2%. My entries were sharp, stops tight, take profits clear. Trade 1, $40 profit. Trade 2, $50. Trade 3, $30. Trade 4, $60. Trade 5, $50. Total, $230 in gains. I thought, I'm getting this market. Time to step it up. For trade 6, I tripled my size, risking $60, even $80. I skipped the stop loss, thinking I'd exit manually if it went south. It did, slowly at first. I didn't cut it, clinging to the peak I'd just left. The longer I held, the more I feared losing my gains. When I finally closed, my account was at $800. One trade cost me $430, more than my 5 wins combined. 5 wins, 1 loss, and I was still down. A 5-6 win rate, beautiful on paper, but I lost because my risk wasn't consistent. This is the trap of high win rates without risk management. You think steady wins mean profits. Wrong. It's not about how many trades you win, it's about how much you risk per trade. If 5 wins net $40 each but 1 loss costs $200, you're sunk. I saw this with a young trader, Liam, fresh off a basic trading course in LA. His first 7 trades won, each netting $20, growing his $100 account to over $200. On trade 8, he went all in, risking nearly $200. It bombed. Like so many, he asked, how can I win 7 times and still go bust? The answer, you don't die from a low win rate, you die from one trade where you risked too much. The formula to avoid the trap. In trading, one equation matters, risk-to-reward ratio and per trade risk. Say you risk $10 to make $30, a 1:3 risk-to-reward. You can lose twice, win once, and still profit. But if you risk $100 to make $20, even 6 wins won't save you from 1 loss. Here's how to stay safe. 1. Cap risk per trade. Never risk more than 2% of your account. On a $1,000 account, that's $20 max loss per trade. 2. Maintain a minimum 1:1 risk to reward. Don't risk $50 to make $20. A solid ratio means you don't need a high win rate to profit. 3. Stay consistent. No big bets, no skipping stops. Wins don't make you invincible. Trading isn't a sprint, nobody wins by being fastest. The winner is the one who lasts, controls risk, and doesn't self-destruct. You don't need to win every trade, just survive the big losses. Why risk management is your lifeline. Every trader who's blown an account has asked, why did I win so much and still lose? The answer lies in 2 pillars of risk management, fixed risk and proper risk to reward. Fixed risk, your safety net. Imagine a $1,000 account. You decide to risk no more than 2%, $20, per trade. Now picture 10 trades, 5 wins at $30 each, 5 losses at $20 each. You net $50 because you kept risk and reward consistent. Fixed risk means whether you're on a winning streak or rattled by losses, you only bet a calculated sliver. It curbs the urge to go big after wins and keeps you calm after losses. Risk to reward, winning without being right often. How do you profit with a 40% win rate? Risk to reward. With a 1:3 ratio, risk $20 to make $60, you lose 6 trades, $120, but win 4, $240, netting $120. You don't need to be right often, just right enough. How to apply it? 1. Set your risk. On a $500 account, 2% risk is $10 per trade. 2. Define entry, stop, and target. Say you buy euro to US dollar at 1.0800, stop at 1.0780, 20 pips. Your $10 risk over 20 pips means a 0.05 lot size. 3. Set take profit. For a 1:3 ratio, target 60 pips, 1.0860. Never move your stop when losing or cut profits early, it breaks your structure. Don't turn trading into gambling. Without fixed risk, every trade is a dice roll. One day you risk $5, the next $200. One trade's based on a signal, another on a hunch. Wins don't matter if one bad trade can wipe you out. Trading isn't about big bets on sure things. It's about small, calculated risks on good setups, repeated consistently. Thanks for watching. Somewhere in these stories, numbers, and warnings about risk, you might see yourself, a trader who nails entries, waits patiently for setups, but loses not from bad analysis but from weak risk management. This video isn't about getting rich quick, it's about surviving long enough to evolve, to mature, to stay in the game without a dumb trade knocking you out. My mission with this series is to rebuild your foundation, to arm you with a bulletproof risk management mindset. In trading, those who keep their capital keep their shot at success. The market will always have waves, opportunities every day, but you only have one account. Don't chase profits daily. Chase preservation daily. Those who preserve will, in time, learn to profit. Wondering how to stay cool through a losing streak? How to turn probabilities into your edge? Catch the next video, Risk Management Like a Casino, Live Like the House. I'll break down how casinos profit even when players win short-term and show you how to think like the house, not the gambler. You don't need to outsmart the market, you just need to outlast it. To you, learning to master yourself before your money, keep going. You're on the right path. I'm here with you, video by video. See you in the next one.